What's up, guys? Welcome back to another episode of Xerox Research. Today, we have a very, very special episode. Actually, two episodes combined in one. Today, we're going to be sharing with you guys the podcasts that were recorded at EthCC with partnership with Karpatki and the Blockworks advisory team. They recorded two podcasts on lending, vaults, everything DeFi for EthCC, and I hope you guys enjoy.
Hey all, Blockworks co-founder Michael Ippolito here. Quick break to talk about something we've just launched, Blockworks Investor Relations. As the market shifts toward institutional capital, investors want more transparency, more standardization, and a higher level of professionalism. But the traditional IR model is slow, manual, and not built for how crypto works. If you're building on-chain, your data is already live, your business is already transparent. The challenge is turning that into a clear, credible story for investors. That's exactly what we're solving with Blockworks IR. It's a single platform that brings together real-time analytics, branded investor portals, and hands-on advisory support so you can communicate what matters. If you're an on-chain business looking to level up your investor strategy, check out Blockworks Investor Relations at blockworks.com/investor-relations. All right, back to the episode.
Nothing said on Xerox Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Welcome. Really appreciate that you could make it here. I'm Marce, CEO of KPK. We were born 5 years ago, building the infrastructure we needed back in the day to manage DAO treasuries and also actively manage some of the largest ones like ENS, Gnosis, Aave. And we've been deploying billions without losing funds. And this is really the second event we've done, scaling DeFi. The first one was last year in Debt Connect in Argentina. I think it was a very different crowd in that moment. I would say last year, was mostly engineers, protocol developers, and I see different faces. We also have different co-hosts. Today we have a Gearbox, Euler, Anchorage, and Redstone. So really, really strong teams building. And yep. So the main thing I would say is right now the crowd is different. I see we have more asset managers, infrastructure providers, institutional providers. So that's a pretty big change. Today we're gonna have this. Another thing that is gonna be different is the format for the event. We're gonna have a live streaming of a podcast by 0x Research, by Blockworks, and it's gonna be moderated by Anastasia and Silvio. So after a while, we're gonna have two sessions. It's gonna be a conversation. It's gonna be recorded. You can hear it afterwards. So that's gonna be the main thing. Afterwards, you can go outside. We have a very nice. Today is nice weather. So hopefully you're gonna enjoy this. So before starting, I want to name one thing, and this is that really crypto got boring, I would say, and it's something that is painful for many of us, especially for an industry that's been traditionally pure hype based on vibes, based on speculation, right? Especially today we are very deep in a crypto prices bear market, even though some people want to deny it. So what is different this time is really that I think is the first crypto prices bear market where we have where we're basically boring, right? It's not interesting. So many people think, no, are we gonna survive it, right? Because it's not cool anymore. And still, we see we have $300 billion in stablecoins, almost $30 billion in real-world assets and growing. We have BlackRock building on top of Uniswap. We have Visa settling on USDC. We have the Genius Act. We have Mika. And I would say, even though some of us, not like many people today are not so much interested, in DAOs, in the original things, in let's say, not so interested in governance tokens and these things. Still, I think that the crowd today is much more interested in, let's say, settlement assurances, how we're gonna have insurance for deposits, how we're gonna manage risk and make sure we're building this infrastructure we want to build. And having said this, I want to mention what's scaling DeFi means to us. For us, it's really open source smart contracts, can be verifiable. So basically, if anything you're building is just a black box, it's just basically just TradFi with extra steps. That's not how we're gonna build on top of each other. Another important thing is risk management. We know doing proper risk management and operational security is not just having somebody making good decisions fast. It's having the infrastructure required to act in 0 blocks delays, with predefined rules, verifiable rules. So that's the industry. That's something that can work really at scale. And with all of the real world assets, these trillions of dollars that Larry Fink keeps talking about. I know for some people, really, this is just another distribution channel. I think what we're missing is all of the economy of derivatives we can build on top of these Legos. I think this is really what is going to make a difference of assets on chain. And all of this, the way we're going to scale this thing is by making it secure, by making it open, transparent, bringing the Ethereum values to the financial industry. So many of these things are not exciting. Everything when it tends to be long term sounds a little bit boring. So boring work is good. Boring work scales. And people who are here, they're building that. So now we're gonna move to Silvio and Anastasia. Thank you.
So it's great to be here. And DeFi got boring. I hope that this panel won't be as boring. But I'm gonna try to do my best. These are all very familiar faces, but nonetheless, I want each of you guys to have a 30-second introduction, and then we can get started. Please.
So just introduce myself, so I'm gonna skip it.
Hi, everyone. Marcia Blacken with Anchorage Digital. I lead growth and strategy for Porto, our institutional self-custody wallet. Many of you know Anchorage as the first federally chartered bank for crypto in the United States, but we've grown the offering in terms of infrastructure, going beyond just staking and governance to self-custody trading. Self-custody is a means through which our clients on the bleeding end can access DeFi.
Hi, everyone. My name is Oya. I look after EMEA for Ondo Finance. Ondo focuses on tokenization of liquid financial markets. We're building what we call Wall Street 2.0 by bringing traditional financial markets on chain.
Hey everyone, this is Jonathan, CEO at Orly Labs. We're building a DeFi borrowing lending protocol and vault infrastructure on DeFi. Yeah, very happy to be here.
All right, so it's very clear that stablecoin have PMF, and someone said stablecoin are like the WhatsApp moment for crypto. So I wonder if you guys were to pitch tokenization and RWAs to financial institutions, but also as well to DeFi protocols, what will be your pitch? Like for stablecoin, it's instant settlement, global money. It's pretty obvious what the benefits are. For RWAs, I feel like it's still a bit fragmented and not very obvious, and each of you will have different perspective. So maybe we can start from Jonathan, and yeah.
Yeah, I think the pitch is a little different if you're talking to institutions or retail. For institutions, I would say it's utility, efficiency, and speed. Because crypto and DeFi really allows a 24/7 market, and TradFi moves at I would say, on average, slower speed, and on weekends, it's very a lot of the financial instrument doesn't really trade on weekends. And for example, a lot of the institutions can hold a lot of treasury bonds or low duration private credit instruments, and you leveraging DeFi to boost up their yields or borrow against them, use collateral. So there are a lot of more tools that these institutions can do through RWA. For retail, I would say the pitch would be open access. For example, we are a partner to Ondo, right? So a lot of the retail currently don't have access to US stock market if you live outside the US, and that's just one example. A lot of the financial instruments on the fixed income on the bond side, if you are not a high net worth or accredited investors in the US, you are not able to invest or get access to these financial instruments. So I would say the biggest opportunity unlock to retail is the access to a wide array of financial institutions and also their products. Yeah.
Yeah, I'd agree with that. And I think the trajectory that RWAs is following is very similar to stablecoins. So stablecoins initially were attractive for remittances, more retail use cases. And now the payments companies, anyone who's doing payment processing or fintech and payments is looking at stablecoins. Similar with RWAs, I think the first initial client group was regions who couldn't easily or cheaply access US markets. So that we saw the adoption really quickly. But then on the institutional side, I think the utility point is really important. And I think RWAs has the potential to really bring multi-asset to asset managers where it's not just restricted to listed markets, but you can do crypto, commodities, private credits, stocks, ETFs, all via using this one tool.
Yeah, and I think the pitch to institutions is that, DeFi proved the model. Like, in the last 7 years, we have been using Ethereum, Bitcoin, Solana, XRP as the collateral asset. And it's really stress test the system in terms of ensuring that it's able to work and function and deliver the exact parameters that you would expect in terms of getting liquidity. And so real world assets coming on chain that just, stabilizes in terms of, the addressable market. That's trillions of dollars that are going to come on chain and match the liquidity being provided by the stable coins.
Yeah, I think all of these are really good points. Collateral is super important. Accessibility to more markets, that's something, of course, that's super, super attractive. In my mind, we have the first time in history the opportunity to really have a global financial system that is not that is really integrated and not necessarily compartmentalized in, let's say, um, countries. So that's really the first time where if we do it right, we can have access to to all of these collaterals, but in a more transparent way that could potentially, if everything is connected, ideally we will be able to predict and avoid larger systemic risks.
No. Talking about systemic risk, one very, very obvious concern that most people have is transparency and risk management. So this is like a multifaceted issue. So I wanted to get your guys' opinion on this, and like if you have a magic wand and will solve like problems in this area, how would you go about it? Maybe I start with Marsha for this one.
Yeah, in terms of transparency, I think we have a first party, third party issue where oftentimes like tokenization's happening where underlying collateral is being in the legal structures through which they're being, developed does not necessarily confer legal rights to the end user of the token. And so when you're, dealing with, acquiring the token and then, something happens to, the data or something, it becomes illiquid because you don't have the legal right to redeem at the first party level. Instead, you're this third party holding a token that doesn't have much liquidity except in secondary markets. And then you become a taker in terms of your access to the capital. So it is I feel like there's concerns around, being able to tap into the global markets if it still remains permissionless and permissioned and your legal rights don't pass through to the token holder.
Yeah. And how about the on those like legal right? How you guys are thinking about these? Are you actually owner of a stock if you own an older stock, and how you guys are approaching this?
So our model is what we call a tracker certificate. So token holders get the performance and the corporate actions of the underlying stock or ETF, but not the beneficial ownership. There's a lot of criticism around or debate around native issuance versus the wrapper model that we're doing. And we can do both, but we chose this model because we found it's preferred by the clients. And I think if it's done correctly in a bankruptcy remote structure where the rights of the token holder are clearly defined and you know what to do when things go bad, then it's a pretty secure structure. I mean, in traditional finance, it's very similar to total return swaps, where the bank or the issuer of the swap holds the underlying and they just write the swap to represent the performance. So it's a model that works. And I think the first example of this is stablecoins. They use a wrapper model for dollars, and everyone knows they worked so far. Unless you do algorithmic stablecoins, then let's not talk about.
And yeah, this is interesting, and I think like the way you structure these assets is very important. That there's like downstream consequences to the whole DeFi markets. And so to that point, I wanted to ask Jonathan a question. So like, how do you see these trade-offs at the issuer level impacting the DeFi markets? And also following up also your opinion, Marcel, on this.
Yeah, so on this, we do work with a lot of risk curator partners. Obviously, KPK is one of the close partners that we're working with on a lot of these RWA markets. Understanding how risk are expressed on DeFi is a top priority because we're introducing a wide range of different financial assets on chain. That includes tokenized equity, that includes private credit, treasury bond. We're also discussing kind of introducing commodities on chain as well. And each of these assets trade on different speed, and they have different kind of risk curve and characteristics. So for us to open markets and allow user access to these financial tools, we have to partner with high quality risk curators and managers in the space who understand the risk. Some of the bottleneck that we're currently seeing are in terms of the price oracles, but also in terms of how how frequent these assets are priced to the market. With for example, longer duration bonds, there is a bottleneck with the in real time price curve and also mark to market, and we call it NAV. So it does create a little bit of issue of handling that. But I think with tokenized equity, we do have a pretty graceful solution with cross Oracle partners like Chainlink and Redstone. Yeah, I think this is a space that we're diligently like working and evolving on with a lot of close partners, and I think it's a top priority for us to really understand the risk very well, to protect the users. Yeah. So.
Yeah, I would say on top of that, something that is critical for this is understanding where are the liquidity restrictions and how we can enable redemptions, because that's at the end it's when we have sometimes misallocations or liquidity, we can have wrong prices that can trigger liquidations, and those liquidations can trigger some other liquidations. So basically, the risk properly done, uh, understanding what are the variables that are gonna trigger certain effects, especially when there is a hack or a high volatility event. That's something that is critical in order to exactly protect, remove liquidity early. So even when there is one of these situations, there is a possibility to recover. That's something that uh, many people don't know, because there are fractions of liquidity you can recover when anything happens. So there is always a lot of value on doing proper risk management. Yeah.
Right. Yeah, I agree. And my next quick follow-up question is, do you think risk is more a matter of like the fact that there is not like a common transparency is more a matter of being the market being fragmented, or just the issuer like not being transparent enough? Where do you think the problem lies? If you have any takes, any of you. Like obviously there are different asset classes and different standards, but where do you think the problem lies? Is more on the issuer side? Is more on the just market structure that we have right now?
I'd say it lies in the market structure, because like Anya gave a good example of how like Ondo is structuring things, and in terms of a market structure, it's a liquidity supply match, and when you go into real world assets, there isn't yet a price discovery mechanism for the assets when they're off chain and on chain, and so you have to rely on the data that you're being fed, and there's if the market's moving fast. So I kind of think about what's going on in the latest like credit crunch, where there's been some private credit firms that are gating access to their funds, where redemptions are only about 11% a quarter, but they're seeing higher than average redemptions. And I wonder what this looks like when the RWAs, the private credit, they're issued on chain, and what that redemption flow would look like in terms of a vault or an asset, a risk curator. Like, how do they manage that?
I see.
Yeah,
Okay, well,
I think to build on your point, Marcia, I do agree. It's a lot with the market structure. Some of the high risk point usually share a few characteristics. So if the market is not super efficient, meaning that the trading volume or liquidity is pretty thin, that's a risk factor. Two is if the price oracle or price feeds are not always up to date or it has a delay, that's also another risk factor. Three is with if the asset has long duration, long redemption period, that's also a risk factor. So if a certain type of RWA that has multiple of these characteristics, I will consider a higher risk. Um, yeah, so when we're evaluating which market to open on Euler platform, we do that in coordination with our risk managers and taking all that into consideration. If we feel like the market is, for example, the liquidity is too thin, we don't have the capability and capacity to offload or liquidate in a smooth way in volumes in real time, we sometimes would delay certain markets and waiting it to grow more organically and see more organic demand so we can make sure when the market's being stressed, we have ways to handle all the ramification that comes with it. So yeah, that's what we're currently seeing. Yeah.
Okay, so obviously we are talking about the 30 billion market, of which 1.5 is allocated into DeFi. I was wondering if you guys have any take of what's gonna be the asset class which benefit the most from tokenization. Obviously we have now credit, we have stocks. So I'm really curious to know what's benefit more from tokenization, but also DeFi as well. So maybe we can start with the Oya for this.
I think the way RWA has evolved, so it was stablecoins and then tokenized treasuries or yield bank stablecoins. Private credit was done previously, but now it's coming back and being done probably in a more sensible way. Stocks and ETFs. And I think the next iteration is going to be derivatives and structured products, especially because more institutional players are coming on chain. They want to get creative. They don't want to hold just S&P 500 ETF. Like you can trade perps against that or hedge your positions with perps against that or have more creative structured products when you have all the different components of it on chain.
Yeah, makes sense. Spots come first, like with DeFi, spots come first, and then you build all the building blocks. And yeah, same question to you, Marcelo. What do you think is the asset class with the most potential to scale next within RWAs?
So really, the ones we are seeing that are having traction, of course, stablecoins are the easy ones. But I would say, yeah, commodities we are seeing traction with gold, especially, and there is potential for real estate, even though it's proved in the past tricky, very tricky one. But of course, has a huge potential as a collateral.
Okay.
Yeah, I feel like commodities isn't spoken much about, especially in this environment where, we are seeing a lot of participation in like hyperliquid over the last month when, prices were spiking, people wanted to hedge their positions. I'm interested to see where commodities go.
Yeah. The problem with commodity, I guess, is very hard to find a good issuer structure because will be like someone that gives you like barrels of oil. So gonna need to move with the derivatives, just you have these. So that's hard. And to your point, Jonathan, you were making before, you kind of mentioned it, but secondary liquidity and primary liquidity is very important. And depending on the assets, there is no a single way to go about it. I was wondering if you see any best practices, or like this is even very connected with how DEXs and the prop AMs work right now, right? So um, just wanted to know your thoughts there.
Yeah, so what we're currently solve is mostly focus on the private credit and fixed income asset class because
Okay.
most of the bottleneck exist in that asset class right now because they all have different kinds of delay in terms of settlement time frame and also redemption time frame. That's just we're not used to that type of delay on DeFi. We're used to autonomous settlements. Things can just be done in seconds or even quicker. So I think some of the best practice, I'm actually been talking to protocols like 3F and a few others that working on RWA looping and working on some free market infrastructure to allow more participants, especially from the liquid fund and also market maker to come in that naturally trades the underlying assets, these bonds, these private credits, so they can all chip in and they all have economic incentive as well in this whole diagram to chip in and provide liquidities and offload and also putting on positions as we need so that we as DeFi users and RWA token holders won't like have to wait for months or weeks to get out of their positions, right? So those are some of the things that we're seeing. We just need more fluid free market structure, better liquidities from institutions that currently trade these assets naturally on a large volume, and to find them and coordinate with them in a network, in a decentralized coordination way. Yeah, I think that's something I'm thinking about. Yeah.
Okay. And do you have any other points on this, on the like secondary liquidity, how you guys are evaluating the secondary liquidity for different assets, what's working and what's not?
Yeah, one thing that connected to what Jonathan was mentioning, we definitely need market makers, somebody who can be an intermediary, who can um, eventually inject liquidity if it's required in moments of stress, and also insurers. That's something we've seen of everybody, especially our clients. They're looking for some sort of reassurance, especially a first line of insurance. And I think all of these things are gonna allow to mature this, our sector. Yeah.
Yeah. This brings me to another point. So many institutions actually enter the space through custodians, like Anchorage, and it's also a place where a lot of DeFi activity, s- financial activities originated today. Obviously, RWAs have different compliance requirements, and this is also, I guess, another value proposition. Um, I wonder if the future looks more like a huge permissioned environment, or what would be the coexistence between the permissioned and permissionless aspect. So yeah, I'll start from you, Marcy, and get your thoughts there.
Yeah, and on our side, it's more about the like operational and compliance controls that are in place. Clients are weary of using self-custody to interact with DeFi. And so for like lending or borrowing activities, they want to hold their assets in qualified custody. So securing their loans with Spark or Camino using BTC in custody or stake SOL in custody. But of course, custody is a walled garden. So there's only so much that we can do. And in terms of supporting our clients that are on the bleeding edge, we've offered our self-custody solution, which allows them to directly connect with any protocol that they want to interact with. So, so if they want to go further, they have a browser extension to do so.
Hmm. I think we're likely gonna have both. I think both are gonna grow. I think we're gonna have this permissioned economy like they exist today, and they're gonna replicate. But we're also gonna have this permissionless that is gonna act as a sort of a bridge within these permissioned markets, just as a sort of an arbitrage. Like just like today we have, um, you know, um, shadow economics that tend to bridge different permission markets. So I think we're gonna have both, and both are. We need both to have some sort of equilibrium.
Yeah, I think it depends who you're talking to, really. Like if you're a prop fund, you're just managing your own money, then maybe permissionless works well for you. But if you're managing external capital, your investors are going to ask who your counterparties are, the venues you use, and what sort of protections they have around them. So the fully permissionless open system might not work for one, but it's pretty much required for others.
Yeah, I think I agree with everyone. We're infrastructure provider. We've been focusing on permissionless technology for years, and that's always going to be and continue to be a focus for us. But there are growing interest on the permission vaults solutions from the institutional side, so they can stay compliant and feel safe from the regulatory environments. So yeah, we are one of the few lending and borrowing protocol that can build fully permissioned vault infrastructure and tech. We recently announced a partnership with Securitize as a first use case of that. There are a lot more partnerships with custodial providers and other tokenization platforms and issuers like that. I think that's the adoption of the permission vaults will continue to accelerate, I think. Yeah.
Okay. Yeah, this is very interesting, and I wonder how the counterparties will evolve. Like, so my question is, what do you guys think is the like main user today of RWAs, and will be the next marginal users? Where is the next leg of growth for this market coming from? Maybe I start with the Oya for this.
Yeah, I think, as I said at the beginning, it was primarily retail, but I think the next significant user group will be asset managers who are moving their strategies on chain. They obviously have a lot more capital, they trade in bigger sizes, and they can get a lot more creative with what they do on chain. And once that side is demanding this, then all, the prime brokers, banks, market makers they're trading with, they would also have to look at options to facilitate this.
Could you expand on this? What do you think is the like end customer for these asset managers? I'm thinking about like fintechs that provide like instant yields. I'm thinking about like an asset manager of a bank of this world that starts to use DeFi. What do you think is the whole value chain? How do you imagine it?
If you look at ETF issuers, for example, they can have fully on-chain ETF issuance, and then the clients or retail customers who buy that ETF, then they can have exposure to not just what you would normally get in the stock market, but whatever can be traded on chain.
Okay. Marcelo, do you have any other comments on this, like on the next kind of counterparties that are coming, and why they're coming on chain?
To be honest, I don't know where the demand is coming from. No, we're building the infrastructure. We make sure it works, and yeah. Okay.
Yeah, I can add a little bit. So I can add a little bit. So you guys probably have heard a lot of the centralized exchanges, crypto centralized exchanges, allowing people to trade, to buy, to purchase, and get access to tokenized equities as well. So I think that will onboard a lot of emerging country retail investors that can get access to a lot of U.S. stocks to start with, but hopefully more country stocks markets through crypto exchanges and tokenization. I think on the retail side, this would be a big adoption point. On the institutional side, I think they just wanted to further diversify their portfolios on chain because they're more sophisticated. They look at their on-chain portfolio from a holistic perspective, and they shift their positions from risk-on moments to risk-off. So if it's a risk-on moment, they will switch to more Bitcoin, ETH, more crypto-native assets. If it's risk-off, they will probably hold more treasury bonds. They'll probably hold more tokenized gold, those type of assets that behaves counteractively to risky assets, right? So I think for institutions, the more options you have are arguably obviously the better. For retails, I think the centralized exchange tokenization stocks is a huge unlock. I think will be a huge adoption. And we will see what the fintech partner can unlock as well. I think it's probably just going to start with stablecoin, but they're probably going to allow tokenized stock as well pretty soon. Yeah. So
Okay, I see. All right, I think I'll do the last question, and this will be about where do you see the space in 3-5 years from now? What are the things that have happened, and what are the next steps over like this journey? So yeah, maybe Martis, if you want to take this.
Yeah, I see the space moving in the direction where, like the fintechs and the crypto exchanges, they're, tokenizing real world assets and delivering liquidity to their client base. No longer are you gated from accessing a line of credit against your equity or a line of credit against your your private credit assets as well. Like I think a lot of that has been very blocked, like retail users have been blocked from using equity unless you have like an account with Merrill Lynch and significant assets, for example. You're not able to tap into the liquidity, whereas in a permissionless system you can go ahead and deposit your tokenized assets and take out a line of credit. And I think where we've in the spaces right now have been on like very varied interest rates that move according to the market, but we are developing systems where there's fixed rate infrastructure where you can accommodate that on chain. So I'm excited to see where that goes.
Do you have any concern, like if the sector fails, like what's could be the cause?
The sector fails. In terms of smart contract risk always comes up, but I feel like where we're moving in the direction with, AI, like smart contract risk starts to really decrease as we're able to pressure test all of the different surface areas of attacks. And so I think we're getting much better there, but I do have concern over assets coming on chain that aren't, as liquid as they should be, because that could cause contagion.
I think two things will happen in 3 to 5 years. One, we saw RWAs give access to on-chain users, give on-chain users access to assets off-chain. So real estate, stocks, ETFs, private credit. And now I think the opposite will happen. So institutions who are not on-chain will move for the previous reasons we discussed and do more things on-chain. And I think secondly, we will maybe not stop, but definitely lessen referring to these as tokenized assets and others as just assets. I think it will mostly be the same thing, but tokenized in the background. Like you'll have traditional brokerages or retail trading apps just having a stocks offering, but it will just be tokenized stocks in the background for a more efficient and seamless product.
Yeah, I think in this next 3 years, I see two different directions. For retail, it's going to the route of simple is better. Basically, one click earn solutions or one click borrow against your stock of tokenized equity. So everything has to be one click, everything has to be super easy, risk managed, of course. And people don't need to understand what actually works in the underlying. They only need to know this is available only through crypto and it works, and you're earning yield on your financial assets. And now you have a lot more tools. And as DeFi builder, we just need to get integrated to all different avenues. That includes centralized exchanges, custodial providers, fintech, wallets, everywhere basically, and allowing a very good front end, easy to understand solution. So that's on the retail side. On the institution, I actually see opposite. Things will get more and more complicated. We need to combine the strengths of TradFi and DeFi, meaning that we're allowing DeFi's advantages, but also we need to make sure we have all the TradFi tools that the institutions are familiar with. For example, on the borrow lending side, fixed rate, fixed term, very commonplace in TradFi, not as common on DeFi. But we also have our own products that's not very common in TradFi. So what we're building on the institutional side is combining the strengths of both worlds. So the demands for institutions will evolve. Right now they're doing some simple staking, they're doing some simple borrowing land, but that needs will continue to evolve and become more sophisticated in the next couple years. And we will stay on top of it and build all the tools that they need to do very advanced financial portfolio management and trading strategies. And I would say one last thing is, let me think. Just lost my train of thoughts. Yeah, I would say one last thing is, for financial institutions, I think the future is going to be risk measured, but also highly capital efficient solutions. And there are things that they are learning from crypto too. For example, the 24/7 stock trading markets. You guys are seeing like large stock exchanges saying they're adopting tokenization and crypto technology. This is a brand new space for Wall Street, for TradFi folks, which is an industry of a century plus old. And they're learning new things from us. They're paying attention and investing actively. So this is what we as DeFi builders are super excited to kind of show them what crypto can really do with them together. So yeah.
The way I see it is, I think in a few years, we're going to start having some assets that end up being more liquid on chain than off chain. And I think there's going to be eventually a tipping point where all of the infrastructure is going to migrate to blockchain pipelines. And we are, as a users, we are not going to realize about that. It's just going to be abstracted. And that's gonna be the moment where DeFi is gonna stop being a thing. It's just gonna be finance. That's how I see it.
I love that. 3 years is super ambitious, but that would be incredibly bullish for like the whole audience here. All right, time to wrap up for the first panel, and it was great having you. Great conversation, and I think you can see the recording in a few days in a 0x Research podcast. And thank you.
All right. So the one who is not here, it's his own or her fault, because DeFi maybe or crypto is getting boring. But I think today's topic is not boring because we're talking about capital efficiency, yield, and risk. And I think APY is the word that is thrown away a lot. And I have an amazing company and I have so many questions and I'm super excited for this talk. Let's introduce you guys and let's start with you, Gian.
Hi, I'm Giel. I'm the head of risk curation at KPK, and I'm mainly involved in everything related to vaults and yield generation.
I'm engineer. I'm at Yearn as a solutions architect, and Yearn does vaults with APY. You'll hear about that more, but that's enough.
Nice to see you. Thank you for being here. I am Mike Massari. I am head of Atom and Credora at Redstone.
Hi everyone, my name is Ilgis. I'm from Gearbox. Gearbox is doing lending.
All right. So maybe a little warm up before we go into details. I basically want to know the decomposition of capital efficiency, yield, risk, and everything about it. And you kind of present maybe a different angle of the vault or lending. And I'm curious, how do you define capital efficiency? As for example, for an ordinary depositor.
Yeah, indeed, it depends who you ask. So, for example, for like a depositor, in my opinion, is just like the amount of yields they generate. So the interest they generate per unit of risk. So typically what a retail or like a depositor looks at, mainly if they're not so deep into the space, is just a headline yield, to be honest. For a protocol, it's different. Like capital efficiency is like how much of the capital is being borrowed out on the lending market, for example. So yeah, it really depends on who you ask and what they're looking at.
Engineer.
Yeah, I think the key word that you just mentioned, Gil, is per unit of risk. And I think these units of risk are very poorly understood in the space. Maybe not by some of these other panelists here.
Maybe not soon. We'll see what happens.
Yes, we'll explain it soon. But yes, this idea of capital efficiency, basically the idea that your assets are doing something. Let's say the opposite of capital efficiency is assets just sitting and doing nothing. So rather than define capital efficiency, I'll just define the opposite and let you infer from there.
Yeah, not much to add here. I think this is a great question because you're right, engineer. This is a topic that is poorly understood in Web3. We're going to talk more about it today, but at the end of the day, capital efficiency comes from the delta that there is between return and risk, right? At the end, this is what happens not only in DeFi, but everywhere. And now in DeFi, we focus a lot on the return part of things. And mistakenly, maybe some of us thought about capital efficiency as being the return of things without thinking too much about the risk. Now we're seeing a bit more of this balance. So yeah, definitely interesting time and interesting conversation to have.
For lending markets, I agree with Gail and engineers that idle liquidity, keeping it as less as possible. I guess that's one of the sides of capital efficiency. Another side, I guess, comes for borrowers, like another side of protocol. And here, I guess, this here angle of efficiency is how much it costs for you to rotating capital, to do whatever you want, to switching from one strategy to another, because it also usually comes with some inefficiency in the market. You always do like swaps, have some redemption fees, etc. So how much you pay for it, it's also affects your efficiency of your capital.
Okay, completely agree. We will dive deep into risk-return trade-off, absolutely. Before that, I want to ask you something different, and it is with respect to incentives, because capital is incentivized, and I'm curious, what is the structural difference between incentivized APY and organic APY? And maybe I can start with Ilgis.
I guess this is very good questions, to be honest, and it mostly depends on the like where our market's standing right now. So like couple of years ago, there a very big difference because a lot of people are very bullish on tokens, and different different parties who farm tokens, they actually had the internal models, and they estimate value of tokens in different manner, especially like when tokens are not liquid or have some constraints, and people will be able to like to play with this and different sides, like depending on case they could be right or wrong, but different people have different model, and it creates some play and magic in the market that like different players creating actually uh, uh, like order book, yeah, like some value of strategies in that manner. Right now, I guess a lot of people just considering uh, incentives like in very short-term manner, and in that case, I don't see very big difference right now, at least from my perspective, for incentivized strategies and like purely organic yields. So I see that a lot of existing players just see it like pretty much the same, and they consider it in very short term. And even they, if there is some incentivized, sometimes they like consider it in even in like pessimistic way, because you always when you farm like you have some time before you claim rewards, so they always like consider it like in pessimistic way. But yeah, again, like we saw that happens all the time in the market. Yeah, like we are in very volatile space, and yeah, so people like always playing these numbers, and I guess like this change like hope soon, but who knows.
Quick show of hands. Who likes free money? Oh, that's a lot of hands. I think that's all you need to know about incentives. We see a lot of money moving around because of incentives. When you don't have incentives, life is hard. I think that show of hands explains it all.
Yeah, I think it's also very easy to discern between the both, right? Like organic demand and organic yield, they scale with TVL, while like incentives, they scale with the treasury of whoever is providing them. So, for instance, now like PayPal is doing huge incentives on PYUSD. But I consider that more to be, let's say, a marketing expense rather than actually organic yield as also driving borrow demand. So I think you can easily like see how they scale with TVL and draw your own conclusions.
Yeah, I completely agree. I think that you mentioned time, and time is really the key differentiating factor here, right? So if you're incentivizing yield, which I do 100% consider to be a marketing expense, then at some point they will end, right? So the longevity of the yield changes. Obviously, by definition, organic yield has got more longevity than incentivized yield on average. So I think that the key differentiator is time. At the end of the day, we all like free money. So when you have an incentive, there's no specific reason in a specific time interval to put money in on incentivized yield instead of non-incentivized yield. But at the same time, it's probably not money that you will keep there in the very, very long term.
Okay, I agree. Maybe a small follow-up question. If we have incentives everywhere, do you think there should be kind of an approach to show how much of the yields coming from incentives come from organic, or is it kind of information nobody wants to disclose? What's your take?
I'll take this first. Short answer is yes. I think that the more information someone gives to the investor, the better. So this is as a blanket statement, I think is always true. When it comes to how this happens, obviously there's multiple ways to make it happen. There are some protocols that do and already differentiate between what is, APY and what is incentive on top of that APY. There are some curators that do as well. Obviously, it's just a matter of how accessible the information is. Like when you do as an investor research, eventually you're gonna get to this answer. So it's not to me about whether or not this is obscured, because it is not obscured, but it's about how accessible this information actually is.
Yeah, I agree. Like, I really like the approach of like Vaults FYI or DeFi Llama, where you have these dashboards with yield, and you clearly have this breakdown between what's organic, what's incentives. And also between the incentivized, there's a big difference because some of them might show like a future FDV value of their to be released token, which is a lot of the times very much inflated. So you kind of have to discount it as well. So yeah, like it's a tricky like comparison sometimes because yeah, you don't really know what a value is going to be in the future.
It's very unstandardized, right? So that's the real problem. It's the depending on which asset it is and where it is, and like the information comes in a different way. That's the real challenge.
Yeah, I think the key word in this question is should. Even if we say something should be done, there will be many actors that do not do this. I can give a very simple example. If you are going to any DeFi app, you will see potentially a APY number. Probably you will trust this APY number. The question is it accurate? And
Is it like the 6 hour or the 24 hour or whatever?
And even then, sometimes it's like an estimated value, or maybe there's a token incentive, and this token is not yet liquid, and so it's using an estimated value. Or perhaps the value is stale, the front end has bugs. Whoops, the TVL, the APY is inflated. That was a bug, definitely. So a lot of the time, what should happen is different than what is happening, unfortunately.
I remember all of this old talks about API or APR, if you remember, like. So yeah, we always act like from transparency side. I think we should, in our industry, to push it and to like show in transparent way, because again, like code is a law. Yeah, that's I guess how DeFi like get its initial traction, and that's on what we should like stand for. Again, like in future, I think like with all of this AI automation stuff, it maybe less rely on user interfaces like what's built by developers itself, because like all these numbers can be checked on smart contract level. Of course, like it's very difficult to usual user to check it, but I think in future we'll see all of this like infrastructure that helps users, whatever, like engines maybe, to see like all of these numbers, like and check is it a real number on UI or not.
Because that's a good thing. Like it's, most of us are using ERC-4626, so you can actually query the share price over time, and you don't have to rely on reported numbers. You see like the actual returns in the vault.
Okay. Engineer already mentioned bugs. We always see
It's
this.
a feature, not a bug.
Yeah.
Alleged bug.
Okay, a feature. So what is then a source or a feature of yield destruction? Maybe Gil, you go first.
Okay. Yeah, I would say like, so for let's say underperformance or just general getting wrecked on the yield, I think the main factor is the underestimation of tail risk events. Like we saw a few of those over the past few weeks and months. We had like the Resolve incidents very recently. And I think there in such a scenario, it's often something that wasn't properly monitored or that was missed from security reviews, etc. And is this one single event that can change the whole, the net yield that the depositors get? Like some vaults got hit even today, like they took a big cut on, due to a market removal from the market, due to the affected Resolve exploit. And suddenly you can have like, instead of getting like 4 or 5% yield, it's now at minus 99% APY over the past week. So there's definitely like these tail risk events. I think that's the place where you will lose the most money. Nobody's gonna lose money from like underperforming for like a few hours just to pull funds to safety. You're gonna underperform by getting like hit in these exploits, etc. If you don't have the proper monitoring in place, which I should give a shout out to Jörn for doing this publicly, because you guys like you open source even like all the monitoring scripts, which I really like. We have our own in-house
Agree.
automation, but like I think also the more public we can share stuff, like the better for the whole space in general.
We'll be doing more of that. We're just getting started.
Mike.
I think it's three factors here. There's monitoring, there's time, and there's notification. And so monitoring is like understanding what it is that is happening, right? So the risk, or where this risk comes from, or why it exists, or why it doesn't exist. Then there is time because of what Gil mentioned, right? So obviously this needs to be something that gets calculated over time and then gets timely updated. And third is notification, which is notifying the interested party when something is going awry for whatever reason, right? So this is something that, for example, we're working on a three-prong attack, because a single one or two out of three is just not good enough, right? Otherwise, you can find yourself in a situation like the Resolve situation that happened last week. Now, what to monitor? It's the crucial part, and it's probably what we're going to talk the most about today. But I do think that in order for us to have a complete risk profile, in order for us to understand very well what risk means, they needs to have all three.
I think there are also two sides to look at this problem. Yeah. So first one is from user side, and yeah, again, if you are a small user, of course, it's too difficult, or sometimes costs too much to maintain all the infrastructure. Of course, you can do it, and you just sometimes put money and pray that everything goes well. For bigger players I don't know, like KPK, for example, they run a lot of their own infrastructure to check what happens with their deployed capital. Yeah. And from protocol side, it's another angle. So in protocol, I guess our teams that build protocol itself, they have very deep understanding what happens inside, and sometimes they have their own angle and understanding what potentially could go wrong, or even if doesn't lead directly to losses, but potentially it could in next stages could lead for something bad. And I guess has some this internal monitoring infrastructure for each protocol is crucial to have. And unfortunately, not every DeFi protocol right now focusing a lot on this. And I guess this is something where we can, as an industry, can what we can do better and improve here, doing some standards, sharing some best practices between teams, and focusing on it more. Because yeah, again, it's not something that hidden by usual user and not directly affect on your metrics and TVL, because yeah, very few players who chatting directly with team can understand okay, what's happened under the hood and what kind of infrastructure built under the hood to maintain all potential bad cases. And yeah, but anyway, I guess this is crucial to grow industry from current stage to Marcelo's vision, in 3 years, to replace all current TradFi infrastructure and be a settlement layer and financial layer for the world. So yeah.
Yeah, and it's also a lot of invisible work, right? That might be why not so many teams focus on it, because ideally you never need it, but it can save your TVL. Because on Gearbox, for example, we run this insolvency monitoring developed by the Gearbox team. And what happens is if there would be a shortfall in the protocol, the markets get automatically paused without human intervention. So it's kind of a fail-safe to stop the worst case scenario from happening, even when everybody's asleep, etc. So, and it's something nobody knows because it's happening behind the scenes, but it is there.
I'll be quick. I guess I'll alter the question, which was about APY or yield distortion. And earlier we were talking about per unit of risk. I think there's actually a lot of risk distortion. I'll give an example. If you go to Morpho, you will see a lot of vaults and a lot of APY numbers. You won't see anything about risk. This basically incentivizes the curators to pick the highest risk opportunities that give higher APY numbers, and you don't see that. So it's distorting the yield, but it's really distorting the risk underneath.
Maybe that's going to change soon. No, I have a feeling.
That would be great, actually.
Okay, so I think we already kicked off the topic of the risk, and I'm super excited about. And I agree with you that risk monitoring, risk transparency, risk clarity is something that should be open for each actor in the whole lending, whatsoever, starting from depositors, risk curators, borrowers. And I'm curious about, maybe it will be a longer question. What is actually, how do we price risk? Which metrics do you monitor? For example, you mentioned Morpho. We have lending vaults that have protocol bounded strategies, so you're only in the protocol. And then you have vaults that are cross protocol, so actually you can create a very crazy strategy. So you compose the yield across vaults, AMMs, and everything that you can find suits to your strategy. But I think you also kind of compound on risk, whether it is a smart contract risk, whether it is the asset risk, whether it is credit risk. So I'm curious about what's your opinion on risk pricing and composability here? Maybe Mike, you can start there.
Yeah, so this is a very interesting question. And funnily enough, I think that the risk pricing part of it, it's more up to the curator than it is to the risk organ. Risk exists, right? They exist in everything, and it's something that, again, it's just about how visible and how accurate it is in terms of reporting. Right? When you do anything in your life, whether it is finance based or not, there is a level of risk. And some people are very, very good at doing independent research and figuring out exactly what the level of risk is. Some people are less good. And some risks are much more difficult to estimate. So the first part of your question, which is how visible it should be to which person, the answer is very simple. It should be as visible and as understandable as possible to everybody. That's, I would say we can take all of this as a blanket statement that should be true in everything, in an ideal, perfect scenario, perfect world. I will add that independence is a very important factor here, because having self-assessment of risk, it happens in TradFi a lot, where people, like, you invest in a TradFi asset or in an ETF and it's risk, 7 out of 10 safety, right? And you say, why? And they say, well, 7 out of 10. It doesn't make a lot of sense, right? And it's important that it's transparent and is verified independently, like by a third party at the very least, if not by anybody. So that is the additional factor. Now, how to price it is a result of the risk profile information, right? And there, obviously, higher risk doesn't necessarily mean worse, right? So the more secure investment, they're not necessarily inherently better than the least secure investment. People should have the information and should be able to make their own mind on how to build their portfolio based on what their personal risk profile is. But the information should be there. And pricing should be also there based on what the curator, for example, wants to do with the risk. Sometimes, and I talk with a lot of curators, not being one, so I'm the least expert person to talk about this, but sometimes you want to have a more risky vault, for example, because he generates better yield in a specific amount of time. And that's acceptable, and it's an acceptable level of risk if everyone is informed. The problem, like engineer was saying, is if the information is not there. So if there is a front-end bug, or there is like a misassessment or whatever reason why the information is not transparent. But more risky doesn't mean worse if it's transparent and it's independent.
Gil?
Yeah, so maybe to come back to like from a curator standpoint, like how we do the risk assessments. I think for us it's easiest if everything happens on chain and there's as much as possible information, and it can go very advanced. So, for instance, one of the latest markets we created on Morpho and onboarded in our high yield vault is based on a product by Origin Protocol, and it's basically combining their own infrastructure. Then they combine it with Lido. They kind of buy DPECT or they buy underpriced staked ETH, and they go in the native unstaking queue to redeem it. And that's how they make a profit, which is very profitable in volatile times. Under the hood, they use the Urine Vault. That's not listed anywhere, so people don't know, but like we know. And yeah, they cycle liquidity either in lending markets or in like Lido staked ETH. So for us, the good thing is it's a lot of complex interactions, but we can all monitor them. So for this one specific, we have 300 smart contracts we are monitoring just for this one collateral market on Morpho. So if anything goes wrong, it can go from even like the native unstaking queue of Ethereum, anything happening with the Lido Oracle, with the Chainlink multisig, with all of these components involved, we will automatically exit the market on Morpho within one block, or like as soon as we get the alert in autonomously. So for this type of things, I agree, like transparency is key, and I think we should try to keep DeFi as open as possible. Because we see now a lot of these yield-bearing stablecoin vaults. They might do some legs on exchanges. They might move it into wallets that are where the custody is a bit more a gray zone, like who is holding the signing keys, etc. So from a curation perspective, it helps us a lot to price this risk and to determine like the LTV for that market or maximum allocation if we have that information. So yeah, I would just like advise anyone that's building something, please follow like the standards that are there and try to do as much on chain as possible.
Okay.
Yeah, I think to add to what was just said, there is a bit of a difference between DeFi and multi-sig-fi. In one of these two, you basically give your money to a multi-sig and just hope they do the best with it. Whereas if you're dealing with DeFi, you should be able to fully verify where everything is on chain. And I will say for Urine, the main two ideas related to how we look at risk, it's who controls the funds in terms of centralization, decentralization, and where's the money? If we can't answer these two questions in a way that indicates the value is safe, then really you shouldn't be putting very much trust into it. So just two simple ideas: who controls it, where's the money? These are good guidelines to start with.
And I see it with you guys as well. It's okay to get exposure to risky stuff as long as you can transparently verify it and get out in case something bad happens.
Also, I think one more thing to add is also crucial to have some diversification. Yeah, like because it's always some like probabilities here is that any asset actually can go to zero. Like something could happen, some smart contract risk could exist and be executed not in a good way. So it's always some probabilistic game, and good way is to have like some diversification between different risk profiles. Like having exposure to risky asset is fine, yeah, if it's not at 100% of your assets. So having some like instruments, some tools to properly build this diversification, I guess, is a good way to both like asset issuers, like curators and protocols to mitigate some bad scenarios.
Yeah, and I mean, in favor of the curators, it must be said that most of the vaults actually work like this, right? So there is a diversification of assets. It's very uncommon to have like one single risk profile in the vaults, and every single asset is like particularly risky, right? It would not also be a very smart thing to do. But yeah, I do agree that, you know, understanding it is the first step, and then composing it is a second.
All right. You mentioned diversification, and I think now as RWA are entering the space, I think it gives a big add-on to portfolio that is managed for generating yield, but also I think it gives you a little bit a different kind of risk that is not on chain and maybe not very much transparent. And I think also we have like also more, let's say, movement to off-chain exposure. So I'm curious, how do you see this off-chain risk is being priced? How can you match this off-chain risk with on-chain risk? And how do you then build a strategy to kind of have a healthy, complex strategy risk trade-off?
Yeah, good question. I can like take the first part of it because we're building currently a market for Euler Institutional using securitized assets. So these are tokenized money market funds or private credits or corporate credit funds. So there you indeed you have like a lot of off-chain exposure. It's credit lines. We don't have full insight into the book itself. But of course, you can be quite conservative in the LTVs you set, the different caps you set to how much you can allocate to it. So what we do is we allow regulated or KYC participants to borrow against their existing assets in markets where we have like the full control over the interest rate model, the LTV, the LLTV, and as well as like the caps that are set on that. So that means that you can actually build more complex strategies on top, like a earn vault, like a morpho vault that allocates to different strategies. And for that, we use like Redstone oracles, for example. And yeah, there again, you try to go into as much detail as possible. You try to find the data sources that can provide you with the right monitoring tools. So we will be, for instance, pulling like the Oracle data from Redstone, compare it to other secondary liquidity market prices if those are available. And yeah, again, like it's about getting enough data inputs to make this possible and being not too crazy on the LTV side. You don't want to, give somebody like, even though these assets, they only update typically once a day, the NAV. So you're kind of safer as both a lender and a borrower than in a lot of like DeFi platforms where you can have like continuous price deprecation. So you typically do have some time to react. Like we also act as liquidators in those markets. We can step in, redeem the assets. But yeah, there's a lot of additional like components that in DeFi we were not really used to that you have to take into account. But it can be done in a good way, as long as people that like have to estimate the risk don't like be overly optimistic, because bad things will happen one day or another.
Engineer.
So I think anywhere you put your money, regardless if it's fully verifiable or not, there is always some element of trust. So going back to these two main risk items that Jörn looks at, who controls the money and where is the money? Even if you can verify it fully on chain, you have to trust that the blockchain works, that your computer is working, that the screen isn't showing some bad data somehow. So there's always trust, and I think if there is a way to get this off-chain real-world asset yield in a way that can be trusted, then it gets very interesting. The puzzle is how to do that. I think that's something that's much easier on-chain because we have some trust assumptions with on-chain data. When we're dealing with off-chain, there's always additional entities or parties involved. But that's what I would say. The main item here is trust at the end of the day. It's hard to avoid it.
I agree. Not much to add here. Like the only, I think, valuable added input that I have here is that as part of the risk assessment, both should be considered, right? So considering off-chain factors and on-chain factors, it's important that they should also be weighted in a different way, right? So transparency and accessibility of information is a factor of risk. So if information is more trusted, right, or more controlled by a single party or less decentralized, is inherently more risky than if it isn't. So I think the proper risk assessment should consider both factors and should also weight them against each other in a way that it makes sense, just to spit out like as we were saying before, a standardized risk profile, which is the main problem. Like now we don't have that. It's very difficult to understand it because the information is fragmented. It's very difficult to not only access, but also interpret. Now, if we standardize it, obviously it needs to be done in a proper way. It needs to be done in a way that considers all of this. So I completely agree.
I have two answers, like short term and longer term. In short term, I guess like few parties already building some solutions to check what happens in thread file. So like it allows like to understand like where money is. Yeah. So like guys from Redstone building it, Lamarisk also checking books of like where is sitting exact assets for different debt obligations. So this is, I guess, like first steps. At the end, in longer term, I guess we are talking like, and we will see fully digitalization of financial stack. And right now, like it's something hidden and can't understand that what you can do, just trust, okay, this big financial entity, it has a good reputation, so I can trust my money and put into it. In longer term, I guess we'll see like all the data, like from like high level to very like end level, where money goes, how it acts, where it sits, what kind of limitation it has, and all of this like financial stack will be digitized, and we can see like in a very understandable way, in very like standardized way, so that later like user, maybe not any end user, but at least like more sophisticated players will be able to understand where this asset sits, what kind of risk and hidden risk it has, and deploy capital in more properly and more in better way.
Yeah, I agree with you guys. I have one follow-up question here as well. Mike, you mentioned, and Ilgis, you as well, standardized risk measure. You mentioned trust. So can you give me one standardized risk measure you would agree on today that would be available for everyone in real time?
Okay, so there's many obviously, and there's a number of I will not call it maybe risk measures. I was call them risk parameters. One is depth on liquidity. Like that is a very immediate thing to understand, right? So if something becomes illiquid, there's a huge factor of risk. That I think is probably the one that the most people in this room could agree on. I was pausing to try and figure out what would be the most agreeable. I landed on this.
I'd say that like all the stake, all the financial stake, it should be rebuilt a bit. Yeah. So right now, what happens like when TradFi money comes? I mean, like TradFi products comes on chain. It's actually some legal wrappers of existing products, and these products work in the same manner as they worked before, like in TradFi. And in longer term, I don't think this is like good way. And good way, I think that we should like rebuild all this product in a bit different manner, like when internet came into our lives. Yeah, if you just put a website for some shop or whatever, like service, it doesn't work well. Yeah, it works well when like it comes with all the supply chain that has like Amazon or any other big player now have. And in that case, it increase efficiency on the whole of the system. And I think something similar should happen like in like 5 years, maybe 10 years. Yeah.
I agree. There also like on the RWA side, like illiquidity is a big issue, minting and redeeming is a big issue, and it's currently all going through traditional finance rails. Okay, some projects also allow minting with like USDC, but like the underlying assets still require like US dollars on a bank account. So yeah, I agree. Like there, we can make a lot of progress, and without resorting to, let's say, Zimbabwean real estate as our golden standard, but really build something like sustainable.
What I love, like in old DeFi, yeah, it's fully like liquid and velocity, like very very high. So like, for example, when you onboard Ethereum, BTC, for example, as collateral in lending markets, you always can understand what happens inside it, because you have a lot of and very deep DEX liquidity for these assets, and they are fully liquid, and it's very understandable from risk side what happens with these assets. And I think something similar should happen with TradFi, because like anyway, like even if it's private credit, it still has some like you can understand like what's how it costs right now. And one of the problems like why we have such big redemption periods, that this market inefficient in terms of like speed, velocity, in terms of like rotation capital. And I think such kind of things could be improved by using blockchain technologies and practices that we had in DeFi. Maybe something new, like some new products will appear here to improve that. But anyway, I think that's the direction where we should move.
And as for risk metrics that everyone can agree on, I'll go with a very simple one I mentioned earlier. Do you know where your money is? If you don't know where your money is,
At 5 a.m. in the morning?
at 5 a.m., 9
Yeah.
p.m., midnight, any
Yeah,
time of day.
but you, to be honest, like you always know where money is. Yeah, the problem is that data in some levels just disappeared. Even if it's private credit, for example, at the end, this is some money that was given to some entity, and you have data what happens inside the entity. And the only problem is that this data doesn't move on the next level. So, for example, bank doesn't have this data. So he knows that, okay, something happened like 6 months later, and then it could problem like for portfolio, and then it come like with some problems for RWA asset, etc., like in 1 year, for example. But you have all of this data, like the only problem to gather all of this information together and make it like transparent and available for different parties to be able to measure risk and understand in real time what happens in the whole economy.
Yeah, full stack of understanding, and also, can you move your money for where it is now? Like, oh, it's there, but like, can you actually move it somewhere else?
And like you were saying, if there's only a monthly report, then you really don't know where your money is at 5 a.m. at midnight.
Yeah.
You only know on the first of the month where your money
Yes,
is.
the problem with monthly report, you can automate it and do second report. Each second, you can understand like what's happened with money each
Yeah.
second.
So we need to
Is it-
get all asset issuers on chain, basically. Yeah.
Yes.
Maybe another parts of this coin is which is your early warning signal of an upcoming credit cascade? Some of the people say observing wallets, okay, if I see the utilization is hitting 100%, this is my early warning. And others say that the basis widen for yield-bearing assets. So what is your early warning sign?
Yeah, like I said, we have a few hundred, but I would say like actually like utilization is a great one, like spikes. Ideally, you catch it before 100% because then you're already too late. Then something happened and all the liquidity is gone. So how we do it on Morpho on our rebalancing automations, as soon as a certain threshold gets crossed in the utilization rate, we stop allocating to the market and we will start actively pulling funds from the market as well. So for instance, with Resolve, like let's say utilization spikes above 98%, we will start to automatically withdraw as much as possible, like in the next block from the market. So I think utilization is a great one in lending markets at least, because you see there is a liquidity crunch. And like I said before, we're okay with spending like an hour or half an hour in a less yielding position just to avoid any losses for depositors. But there's a few. You can look at DEX liquidity, you can look at minting volumes, you can look at like abnormal things like DPEX. There's all kinds of early warning signs you can and should monitor.
If you
on-chain.
pick one.
Yeah, it's probably utilization rate on Morpho at least. Yeah.
Okay.
It's interesting because we have been thinking about this a lot. And it's fascinating because it's part of a risk assessment, but it's also is the notification part that I was mentioning before. As in, is the job of the oracle to notify when something like this is about to happen or may happen, even if it's not an oracle problem? I would argue it is. I would argue that as part of the data set that you provide, we should evolve into proactive notifications to risk curators, for example, vote curators, on stuff that is happening. And I'm very happy that Gil and KPK like do a lot of monitoring themselves, which is very noble of you, and it's very involved. I'm sure it takes a lot of time. I would like to see this everywhere. In applied and like as a standard. This is just a standard parameter that comes directly alongside the price, right? Or alongside the specific, information that comes directly from the oracle. So we're thinking about this, and we're thinking about what to monitor and how to monitor it best, and what are the vehicles to serve this. But it's 100% a problem. Utilization, definitely, I would say, the biggest indicator, at least in certain specific scenarios. There are probably 50 to 100 indicators. And obviously, it becomes very involved to monitor those. There's an infrastructure cost, and that there is also, a risk-reward conversation to be had there. But as a general statement, I do think that a lot of this information should proactively arrive to the consumers so that these automation can be put in place in a widespread fashion.
I have that one more DEX liquidity imbalance, because if like something happening, usually like somebody knows some insights, what's happening inside, and that leads to imbalance in DEX liquidity. And if you check these numbers, it can work as some predictor and can help to mitigate like some risk for you.
I will actually defer you to the Urine GitHub repo for risk monitoring, because I don't want to give the wrong answer for which one we look at the most, but it's all open source, so you can check yourself.
That's a great answer. Maybe one follow-up here as well. Gil, you mentioned utilization. And in DeFi, we have this advantage of a public information. So everyone observes the same information at the same time. And if bad news are happening, like utilization hitting 100%, everyone is liquidating the same pool. Each sale depresses the price for the next one. So expected shortfall and recovery is super linear. And then in the end, you have this exit problem. What can we do actually here to solve that?
Yeah, it depends, because like in the lending market, typically there's always funds lent out. So even if everybody wants to withdraw at the same time, that's not possible. So it kind of becomes like a race to be the quickest out of the pool. And like, yeah, we have our solutions how we do this. Like you can go super advanced. Like you can even like start monitoring the mempool or work with like block solvers to even get included in the same block. But typically, like most, like we saw it last week in action. Like let's say liquidity returns in the market, and it's a race for the curators to withdraw as soon as possible. We notice currently like it can be very slow for a lot of parties. I shared like a tweet last week. I think it ranged between like instant to about 500, 600 seconds. So it can be like 10 minutes before like an entity reacts to liquidity returning, which I believe is absolutely insane. And I think we're going to see a lot of more like speed increases and sophistication, especially as more of these TradFi asset managers also move into the curation space. We have like people like Bitwise, and they're also like going to be active in this space very soon. So for us, it's a lot of the infrastructure and the automation we use to detect this, and also couple it to actions to act as soon as possible within like the capabilities of the blockchain, of course. But I believe like the numbers we're seeing now, like I would be very surprised that people are this slow next year.
Okay. Anyone else want to pick up?
I hope one of you can answer how to solve a bank run. I don't have the answer.
Maybe Mike.
To be honest, I agree. I don't have much to add on this one. I think that this is a very specific problem that curators think about much more than we do. So I remit the judgment to Gil.
Okay. Maybe I think that will be the last question actually. You mentioned a lot automation, and it's not a secret that we are in AI era, and we also have like DeFi welcoming TradFi, and TradFi is heavily regulated. So what do you think if we look in the future? Who is going to do risk management and parameter settings? Will it be AI agents, automated things? Will it be regulators or someone else, third parties who will take marketplace?
I love this part of the panel because it's usually the part when I make a fool of myself by giving a wild prediction that never happens. So take this with a huge pinch of salt, and I think I'm speaking for all of us just saying this because speculation is speculation. But at the end of the day, my personal, very personal opinion is that there is no near future in which AI can replace risk assessment 100%.
I'm happy to hear that.
I don't think that will happen. I don't think that should happen, more importantly. And the reason is quite simple. Risk assessment is something that, as we said, has got still a lot of unknowns. And AI models are very, very good on working on known data, but they're not particularly good on working on unknown data and bridging that gap and understanding how big the gap is and how important that gap is. So I do think that in the future we will see more AI when it comes to understanding parameters. Potentially when it comes to even identifying the differences between different risk profiles. I do not hope that there will be ever a switch entirely from human to machine in doing that. The second part of your question, and I'm just going to wrap it up very quickly, goes back to my previous point, which is independence. So the risk assessment should be independent. To me, it's not a risk assessment if it's not. It's just like the Obama meme of people just like giving the medals to themselves, which doesn't make a lot of sense. And it's also the thing that happens in TradFi a lot. This is a 7 out of 10 because it is a 7 out of 10. So I think that there needs to be a standard that needs to be by independent organ, independently verifiable with public methodologies and ways to interpret it that is accessible to the most people possible.
Yeah. I think like historically it's been mainly let's look at like let's say Aave or something. There the risk parameters have been set by the DAO first, but they notice okay this is going too slow, so they move to service providers like Gauntlet was involved, Chaos Labs, etc. I agree. Like I don't think we should like let AI do this by themselves. But I do see a lot of benefit in using AI tooling to help you speed up the process, implement this stuff, and better understand it. So to give an example with KPK, we write algorithms ourselves, but we will have like AI, for instance, analyze or rebalance data and make suggestions where we could improve some of the parameters, like tweak them to avoid, I don't know, wasting gas, for example, etc. So I think there's a real future of, let's say, curators using AI tools to set these risk parameters, etc., in a way that's also regulatory, like compliant. Because that's, I think, unfortunately, that's somewhat the future we're heading in. Like more of finance is becoming like is getting on chain. I think regulation is good to some extent as well, and we're going to see more of it in the future. So yeah, I wouldn't let Claude like run the vaults, although it could be an interesting experiment with full disclosures to like have an AI agent do all the rebalancing and etc. But yeah, I think we're still a way off from doing that safely.
Ilgit?
People trust to people, yeah. Machines to machines. So while agents don't hold most of the money, I guess we are safe.
engineer talking about who is holding the money.
Yeah, I will just repeat what was already said by Gil, that using AI to speed things up, I think, is a good approach in the short term. Whether I can predict the long-term future of AI, I'm not gonna say anything on that.
Fair enough. Fair enough. Okay. I can ask one more question. No? No more questions. So
Yeah,
we
all
have
the
to meet
time.
again, guys, okay? Next year.
Thank you so much. We have to do this again.
Thank you, guys.
Thank you. Bye.